Morning, everyone. This is Mortgage Pros 411, and I am Audrey Boissonou. And today we are missing Kevin Cassey. Hopefully, it's temporary. We'll see. But thank God, and I mean that, thank God we have Dr. Elliot Eisenberg with us. Hello, Elliot. How are you?
It's a pleasure to be here. Wow, thank you.
The pleasure is truly all ours, I swear. Oh, my goodness. So happy you're here.
Thank you. Great to be on.
Yes, I know it's been far too long, far too long. All right, as people join us, I'm going to just let everyone know that Thursday we are looking for Q1 GDP, second read, and pending home sales. And then Friday, what's happening Friday, Elliot? What is
All important income and outlays come out. So the Fed's favorite measure of inflation, the PCE and core PCE in particular, which excludes food and energy, comes out. So, that's what the Fed keys in. They want that number to get down to 2%. It's been falling, but slower of late. So it was fast, and then it kind of slowed down, and the Fed got wishy-washy, and now rate cuts are maybe yeah, maybe no.
wow.
So Friday, 8:30 a.m., I think, Eastern time.
Talk about going right to it. All right. So Friday, personal consumption expenditure, as Elliot said, the Fed's favorite measure of inflation. And as we have seen recently, the latest inflation numbers this last month have been a little better. Not great, but better, right? We've had some downward revisions from the previous month. We'll talk about that later. And they've been a little better. So any expectations for Friday on your part?
Any given month, no. 1 month is a data point, 2 is a line, 3 is a trend. I mean, think of it that way. We need 3. And what's driving inflation right now is really pretty odd. It's 4 things. The first one is rents, and the cockeyed way that the central bank, not the central bank, the Bureau of Labor Statistics or BEA, whoever it is, does it. They have a weird way of doing it. They haven't changed their methodology in 40 years or something. So we know it, but it makes it difficult to understand. And the lack of people moving from one rental to another rental has reduced rental turnover. And it's the new leases when people move in to a new building where you get the discounts and the new rents. So that's slowing things down. So rents are a problem. We understand it, but it's taking longer to manifest itself. But the other 3 are all insurance. Mm-hmm. It's car insurance. Hello, we've all seen that. I actually spoke to the car insurers about a month ago, and I gave them crap and said, I hate you. I hate you. Intellectually, I understand. But emotionally, it's not happening, man. I want to kill you all. So it's car insurance, home insurance, right? If you're in California, Florida, or any of the other 48 states, just about, you got a problem on your hands. And then it's healthcare insurance going up too. The Fed can alter these things. So hopefully the Fed says, look, those are a problem. Yeah, the rent's different. But hopefully they look beyond that and they begin to say we can cut rates soon, but they're going to want 2 more months of pretty decent numbers before they really start getting excited.
You think 2 more months or maybe 4 more months? Maybe.
I think last month was decent, so 2 or 3 more, and they're there. But that gets you into September, October at that point. They meet every 6 weeks, so it's a while.
Right. Oh my goodness. So when we're watching all of this, my understanding is that it is more likely that we're going to have some relief in the rates if the unemployment rate ticks up a little bit, maybe to 4.1, 4.2, versus waiting for the core PCE to get down to 2%, which could be a while, right?
Yeah, so those are 2 different, you're spot on, but you're looking at 2 very different things going on.
Exactly.
If PCE falls down, that's a pretty decent thing. That means inflation slowing. Hopefully the economy is not tanking and we're good. If unemployment starts to go up, whoa, that means the recession horses have left the recession barn and they're infecting the economy and we're getting lots of recession. So this is a really bad thing. And Powell said, if unemployment starts to go up, he's going to start to lower rates quickly, regardless of the status of inflation.
Right.
So we don't want to see unemployment go up because that would really be a bad thing. It's already up from 3.4 to 3.9. That's a noticeable rise.
Yeah.
But it's taken a while to get there. If it keeps taking that long to get another half point, like another year, that we won't get a recession. If it happens in 6 months, however, that's a telltale sign of a recession. So it's the speed at which unemployment rises.
Interesting.
Really important.
Okay, that's a really good thing to note, actually.
So
So
if it happens over a year from now, we're 5 from 3.4 to 4.4. Yeah, it's not great, but
and
don't jump off your trampoline in Phoenix or something, and just
gotcha. Yeah, all right. And then let's talk about the Fed. I mean, let's just talk about the Fed. So they just released their minutes last week from their previous meeting. Their next
right.
meeting is, what did we decide? June
June 11, 12, I think it was.
11, 12. Yep. And so we know that, they're not going to do anything with the rates in June. We know that. Probably not July, August, September. So we'll see.
And then maybe.
Maybe, but it's really going to depend on things like, the minutes or the PCE number on Friday, right? They're really hyper focused on that. But one thing they did say is they're going to ease their balance sheet runoff from 60 billion a month to 25 billion a month, which is
25.
a little better than the market was originally expecting. I think they were saying 30. So tell us
Right.
about that and what you think that might do for us.
I'm not sure it matters all that much. I mean, look, the Fed's balance sheet before the global financial crisis, so this is 08, 09, was a little under $1 trillion. It goes to roughly 4 trillion because of the global financial crisis and Ben Bernanke buying bonds to keep the banks solvent and so on back in 9, 10, 11, 12, 13. At one point, there was I forgot what the words, the cute not euphemism, but the taper tantrum, where Bernanke said he might begin to ratchet back, and the market went bonkers. Rates went up 150 basis points in like 38 minutes or something. It was bad. Anyways, just before COVID, they were already reducing their balance sheet down to about, I think, 3.6, 3.7 trillion. And then it shot up to 8 or 9 trillion during COVID. And now it's coming down again. And the fear that they have is if it gets too low, things go bad. That happened in 19 or 18 or 19 when it was declining too quickly. Liquidity dried up. There wasn't enough liquidity and rates began to go bonkers. So the Fed knows that at some point, something bad can happen. By slowing down the pace, they delay it and they get more information about market participants telling them, hey, things are okay, but they are draining liquidity out of the system. And they're putting more treasuries on the market, which could push rates up in the abstract, ceteris paribus. So assuming nothing else changes, a couple of bips could go up. So this reducing the rate of runoff is going to help interest rates a little bit. And it's likely to reduce the threat of something really bad happening in liquidity markets and banking and the Fed funds rate and all these crazy things and short-term money borrowing at the Fed window or something like that.
Well, I mean, that's all been in play.
MBS, of course, isn't moving much at all because no one's refinancing, relatively speaking.
Okay.
So their desire to get runoff on MBS is much, much slower than anticipated. And they're not selling. They're just letting it run off.
Okay, so here is an interesting little note. Now, granted, it is still off of terrible numbers from last year, but refinances are now 34% of the market. Did you see that?
They did. Remember, the market's not big because no one's buying houses either.
I know, but
no
still, we have
base
to take our
effects
wins when we can get them, Elliot.
But you take them any way you get them. Yes, absolutely. Keep fishing in Lake Mead or Lake Powell or something, right?
Wait, Jerome Powell? Does he have his own
lake? That too, yes.
Hey.
Nice. 3 points.
I know. See how I did that? So, okay, so the Fed's going to do what they're going to do. Can we talk a little bit about, I saw a chart because people kept saying, they're not going to do, I hear both sides. I hear, they're going to make sure the rates get cut before the election because they want to influence it. And then I hear on the other side, people like, they're never going to cut rates in an election year. And Jerome Powell has very clearly stated in his last comments, I listened to him at the last Fed meeting, that they are going to do whatever they think the market needs, and they are not going to be influenced by the political situation. So what's your take on that? Do you believe him when he says that?
I generally do believe him. I'm a little suspect 4 years ago. I have no reason to be suspect, but the person who believes in conspiracy theories in the left half of my mind or something,
your Spidey sense,
Monday mornings from 9 to 11, thinks that maybe Powell was late raising rates because he was auditioning to keep the job with Biden. So he did that. So, but again, I have no reason to believe this. I'm not a conspiracy theorist. I think the data is pretty clear. The data historically shows the Fed does move in election years. So they may not do it like a week before the election. I got that, but they're willing to move. So if the time is right, they'll do something. I'm not sure it's going to matter much because the political science behind election years and people making their decisions about candidates, the data seems to show that by June or July, we've kind of made up our minds, or August, we've made up our minds. So if the Fed starts to cut in September or October, the meeting after, what they do at once, I think it's too late to help or hurt whichever candidate you have in mind. Not raising would help, Biden or Trump, and lowering would help Biden or whatever it is. If they wait that long, it doesn't matter.
I feel like everyone's already made up their minds, but I could be wrong.
Largely, but there's still a little bit of wild card out there, of course.
All right. So again, our next Fed meeting is June 11th and 12th. And then I'm just going to go so people have an idea that beyond that, July 30th, 31st, September 17th, 18th, November 6th and 7th, and December 17th and 18th. So
that September, November, and December meetings, the ones where rate cuts, they won't happen in all three, but they could happen in the first and third if they cut twice this year. And they'd happen only in the November meeting if they're going to cut once this year.
You really think they're going to cut twice this year? Because it sure hasn't seemed like it lately.
It certainly has not. If I had to bet, I'd say no. But don't put it. Look, 5 months ago in January, the markets had 6 or 7 cuts of a quarter point. Right.
That's
so
right.
Market sentiment bounds on Fed, of course, is much less moves less than markets does. They're looking here. The problem they have is these data points of inflation and labor markets are kind of coincident to current. They're not leading economic indicators.
Right.
So they're looking at the wrong data. That's the big. They don't have confidence in their modeling because they botched it on the inflation rise back in 2021, 2022.
You mean, wait, when we had transitory inflation, you mean that?
As a matter of fact, yes. Now, but that said, and to help bail out the Fed, I will say, look, 30 years from now, when they look at this inflation, they'll say, oh, they had inflation from 21 through 23 or 24. That was transitory. So if you're living in it, every minute's terrible. If it's history, yeah, it's whatever.
Exactly. Okay, so I just wanted to say quickly, because this is a big topic amongst realtors, there's been a lot of concern because we had not heard from VA on their position around the realtor commissions when the NAR settlement goes into effect. And so we had heard FHA and the GSEs had all said, yep, we're going to not count that in the seller contribution number. And VA has now come out and said that they will have an answer to us by June 12th. And they have we are fully committed to ensuring that veterans are neither disadvantaged nor overcharged in the home buying process. So they definitely are looking at this, and they're definitely not going to let the veterans be hanging out there, not able to buy houses because they can't pay a buyer's commission, or use a seller credit to pay a buyer's commission. So just know that that's on its way, which is good news, and very expected, by the way. I mean, if you know VA is really in it for the veterans. They really do try to make sure that veterans are protected. They're not going to just leave them without any way to buy a house if they are short on funds. So with that being said, I thought that was good. And also I was remiss last week. I meant to mention the CFPB has actually, that Supreme Court case came back, and yes, the funding source for CFPB is fine. And
that was, I think, a 7-2 decision. So it was a pretty broad.
I have to say, I have been a little surprised by the Supreme Court. I mean, I feel like they are making some pretty even-handed decisions on things that I wouldn't have expected them to make, to act that way based on their origins. And so good for them. That's what we want. We want them to be looking at the different issues and deciding accordingly. I don't know if they'll keep it up, and certainly there are times we disagree with what they do, but yeah, what's your take on the CFPB continuing? I think it's good.
I'm the people who know me know I'm no big fan of government regulation and so on. So I'm not thrilled about the whole existence of CFPB. That said, Had they said it was illegal, the funding source, and therefore all of CFPB legal, all these decisions for the last 10 years would have been able to revisit. So it wasn't a realistic alternative. The Supreme Court did the right thing here, no question.
Yeah, and by the way, just remember that when the states felt like the federal that the CFPB was under leadership that wasn't strong enough, they decided to step in and they upped the ante and started increasing their oversight and regulations. So if you're in a state like California, I mean, it's really it's there's a lot to be looking out for.
Tell me about California. What's going on?
I know, right? So with that being said, I have Mark McCardle scheduled to come join us on June 25th. And we decided to wait a little while because they have a few things coming down the pike that we want to discuss while he's here, and wanted to make sure that those had happened in June before he got here. So anyway, so that'll be interesting. And just the reason I'm going to keep mentioning it for the next however long is I can't put it on our YouTube channel. So you will have to be here at on the live show on Tuesday, 11 a.m. Pacific time or 2 p.m. Eastern time, depending on where you are in the world. I understand there are other time zones in between those people. I just feel like you could figure it out from there.
Don't treat the rest of the country with airline infrastructure. That is just not nice.
Sorry, yes, time constraints, baby, time constraints. So anyway, so yeah, so I think that what the market hates is volatility. They don't like uncertainty. And so I think that if the Supreme Court had ruled differently, we would have been it would have been
bad news.
Yeah. I can't even think of a word to use that doesn't start with an S and doesn't end with show, because that's all that is in my head right now. So anyway, so that's something, right? At least it's resolved.
Yeah,
Let's move forward, shall we? So I also thought it was really interesting. So Freddie Mac has come out with this idea that they're going to have second mortgages. They really weren't clear about any details other than they were going to provide seconds, et cetera, et cetera. Tell us what you think about that. And apparently a group of legislators just chimed in and said, oh, we don't like it. So I thought that was interesting. Oh, you don't like it either. I don't like it. I think it's dumb.
No way.
Redundant, but
no way. No way.
Tell me.
The job of these institutions, of Fannie and Freddie, right, is to help first-time home buyers. Now you've got $100,000 in your credit card, and your FICO's fallen to 375, which is the dead lowest of the three, that the middle of the three, however they measure it. People in Arizona know these numbers or something. I don't. This is risky.
We do cash out refis, right? You do know that. You do know we do cash out refinances on first through the GSEs, right?
That's fine, but that's a first.
Yeah.
You have more protection and so on. And this encourages bad behavior. I can keep my cheap first and now get a more expensive second and be profligate with my credit card or something.
I don't even know. I don't even know if it promotes bad behavior so much as they have made it so impossible for us to do second homes and investment properties and all these other things that are really important to our borrowers. But now you want to wade into seconds? Are you kidding me? I just thought it was insane. I'm like, I would also like them focus your resources somewhere else. What?
Right. Yeah. Spend the money where it's more appropriately used, helping someone get a house.
Yeah, give us a break on the LLPAs, which are
You've already bought the house. Yeah, loan level pricing arrangements. I mean, you've already owned the house. There's no reason to help you now. I mean, stay in the house. Yeah, I get it. Have a moratorium. They had that during COVID. No, this is credit card default delinquency rates are going up right now.
Skyrocketing. Yeah. And those buy now, pay laters, 43% delinquency rates on those puppies. And you don't have to qualify.
Well, at least from what I understand, they're now going to be used as part of your credit check. They're going to be included in this, I think.
That whole thing is just insane. I mean, don't even. All right. So I am so sad Kevin isn't here for this part because I
sad. Am here. No, you can hear me. I can hear you.
What?
Look at that.
Oh,
yeah, I figured things out. Despite the Audery cutting me off from Wi-Fi.
Okay, so Kevin has joined us. He is now the Wizard of Oz and the voice behind the curtain. So it's talk louder, Kevin.
Mm-hmm.
But so just sit tight, Kev. So I gotta tee this up. So Kevin is on vacation, and he promised he would be here this morning. And then
where is he on vacation?
he's in Yosemite. He's in Yosemite.
It's a rough place.
Yes. So
Don't come here.
The view from El Capitan must be good.
So
I'm
the
in
only
the Audery right now, so
the only thing, by the way, that's politically incorrect. You can't call it the Audery anymore. I forget what the
no,
new,
you can. No, it's back to the Audery again. Yes.
What
It wasn't
happened?
politics that changed the name. It was a lawsuit that changed the name.
Interesting.
So
Well,
it's
that
back to the Audery.
all right.
Me probably, but I'm not going to go there.
All right. For anyone else in the country who has never been to Yosemite, they don't care and are probably wondering what the heck we're talking about. But there's this gorgeous, gorgeous lodge in the middle of Yosemite, and it was called the Audery, then it wasn't, and now apparently it is. So that makes it simpler. Okay. So the only contribution Kevin had, because he's very busy partying right now, to today was he sends me this thing and it says, I want to talk about this. Now, based solely on the headline and the picture, I am guessing you didn't read past the first paragraph. So it is thus: statistics are like bikinis, and there is this blonde in a bikini top on the at the front of the article. So then the opening paragraph is: business professor and economist Aaron Levinstein once said, statistics are like bikinis. What they reveal is suggestive, but what they conceal is vital. In business, the statement can be applied to data as well, and actually went on to have a really good point about how reliable is data and statistics. And Kevin and I have both read How to Lie with Statistics, which I think was written in the 1950s and still stands up today. Yep. Kevin?
It definitely was. It's an old rule of lying with the statistics, and we see it all the time in the press with the median home price. It's like, okay, there's the biggest lie in the world. Median home prices don't. If they rise, doesn't mean your home value went up. It means that there's more larger home sales going on than smaller home sales. That's all it means. That is true.
That is true. So Elliot and I had a little chat earlier because we have actually gotten in arguments about this before, and I am not a fan of rolling out information, having it be wrong. It moves the markets and all goes to crap. And then they come back later with these massive revisions, which actually we're seeing a lot of right now, with these inflation numbers. They roll these inflation numbers. The market looks at them and goes, oh my God, sells off, rates go to crap. It's a disaster. And then next month they're like, oh God, sorry about that. We blew it. All right. So Elliot, I promised not to beat him up too much, and he told me that he was going to explain once again why it's better to have bad data than old data.
Well, let's not go that far. I'm not in favor of bad data, but look, GDP, the second estimate of Q1 GDP comes out this week, and then in a month we'll get the third and final estimate of Q1 GDP, and then a year or two from now they'll re-benchmark it again. So you have to accept the fact that economic data is always being revised. They have better data on business startups and business failures, population growth, immigration, legal, illegal, all kinds of stuff. It just keeps coming in. It's better. So over time, you want better data so that your historical modeling that you do is based on good data. Otherwise, you're preventing the models that are being built from incorporating high quality information. That's number one. Number two, the talking heads on television and radio and newspapers should say, oh, this Friday or whatever, we're going to get the first estimate of May unemployment. That's how they should put it out. And they should tell us, oh, and we're going to get a revised estimate the next month and the month after. So don't put too much weight in it. That said, the number is 144,000 or whatever it is. Right. So they should prep us for this. And the reason it's gotten worse of late, secondly, we're getting lots of revisions because the economy's slowing. When the economy slows, you get revisions down. When the economy improves, you get revisions up. So that's another. So in the business cycle, if you're flat in the business cycle, when you're not getting better or worse, you don't get a lot of revisions. There's some, but not so many. So that's that, right? So there's a whole bunch of, and thirdly, the response rates on the surveys that the government conducts unemployment numbers, and there's two different surveys, there's the establishment survey and the household survey and so on. So the response rates have fallen. So the standard errors are well up. So to get back to the 75% response rates takes them now 3 months to get there, not 1 month. So the data quality is poor, the cycle's bad, and so on. What we need to get the data out within limits as fast as we can to help people make decisions. Even if the current data for May is crummy, well, we've revised April. So that's helpful. Do you want to wait 3 months to get the data? That's really a long time to wait. So you have to weigh this, get it out sooner, but lower quality. And these decisions have already been made a long time ago, and they're not revisiting those decisions.
Okay, so I get what you're saying, because when you're doing the modeling, which I'm not a huge fan of, and because you're looking backwards when you're doing modeling, right? So you're saying, okay, historically, this is what happened. So we're going to anticipate that will continue to happen. Therefore, here are the modeled numbers that we're going to use for this particular month, right? Okay.
Essentially, yep.
Okay. I mean, there's so many things wrong with that idea in my head.
Can't
Just
argue.
Wait, you can't argue, or you're afraid
Can't
to argue?
Look, economists can't predict recession, so our modeling isn't very good. So I accept that.
Okay, but there's no other way.
But Powell and these guys, they even if they don't trust the May data, when they revise the April data for the first time and the March data for the second time, they know the March data has become really good now, and the April data is getting much better. They can ignore the May data. I mean, or whatever they do. I mean, they're not stupid. They know these revisions are happening too. So you're getting better data backwards in March and April here still. So there's something to be said for this.
Yeah, well, they're not very good at projecting.
I mean, this is like a bit like, I mean, your point is, look, your point is economic history is a bit like history in the Soviet Union. When, Lenin's enemy disappears, they cut him out of the photographs and they whitewash him out. So history is changing all the time. Yeah, I get it. I know it's quirky. It's bad. I wish it weren't the case. We're not like an accountant where the books are closed and that's it. In July, the month of July is never revisited. No, we revisit July for years.
I'm sorry, I'm laughing because last night I have a brother-in-law who's the most random. He says, like, just wait for it. He says the funniest stuff sometimes. Last night we're like, literally, I'm putting pictures in different places in my house, and he goes, "Do you have any historical photos, like of Stalin?" Like, what?
I'll get you one. We'll get that one.
Imagine having Stalin hanging in my house. Anyway, sorry, little traipse down last night memory lane because it was really, really funny. Anyway,
I sympathize with you.
What?
I sympathize with your frustration. I do.
It is frustrating. It's really
guys on CNBC and Bloomberg that should be saying, hey, this number is going to be revised twice next month and the month after. Don't put too much stock in it.
Elliot, I've watched, it's interesting, even like sometimes on Bloomberg, the people being interviewed are like former Treasury secretaries or people like that, right? And
yes,
they
are.
Don't understand the data that just came out that morning, and they're being asked to comment on it. And
so often they're also political hacks. You get the current, White House economic advisor, in advance what she or he is going to say, it'll help their boss.
Yeah, well, but the other one is like, oh, here, this guy was the Treasury Secretary at one point, and he may or may not have any sense of what's going on in today's market. And boom, all of a sudden, they're asking his opinion, and I'm listening to it going, dude, that is not even close. And so anyway, I find the information that we're getting is very plentiful and often not correct.
Plentiful and weak. Not correct is a strong word, weak.
Is it?
But keep in mind, as we get more data, we can say, look, how is this data compared to a month ago's data?
Yes.
Oh, it's better or worse. Okay. Now there could be seasonality, so you have to control for seasonality and so on. You can compare a year ago, 2 years ago, 3 years ago. That's helpful too. So you don't want to look just at the current number. You want to compare it to something that gives you some frame of reference. Yeah. If I tell you in the year 2100 that your stock portfolio is worth $12 trillion, you might go, oh, goody. But then you find out a hamburger costs $20 trillion. You go,
right.
Oh, not
and
so
you're
good.
Dead. So there's that.
So it does help us.
Yes. I get it. I also think that the whole idea of doing these surveys is going to get harder and harder, because not only are we not answering our phones anymore, because why would you want to?
Right.
But also you can't click on anything. So, I mean, I get little things that pop up and say, hey, take this survey. And I'm like, no, I mean, why would I do that? So
Doesn't
they're
affect
going
your
to need
phone.
to do this a little differently, I think, because the only people answering their phones are these at this point are I wanted to say the 92-year-olds with a landline, but I'm not too
That's
far
average
off.
is 92-year-olds with landlines. But kidding aside, the places that answer these surveys, it's the same person every month. It's at a shoe
Do you
store.
sign up?
I'm making this up. It's the manager of the shoe store or the president of the pants pressing company or something, and they expect a call. They know it comes. Blah 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 blah. They may not get it every month, but they're surveying a relatively large sample size, so you can get it a couple times in your life. It wouldn't be unreasonable, and they get pestered with other government surveys as well.
Funny how I don't know anybody who's ever gotten that call.
I've never gotten that
Yeah.
call. And by the way, I mean, one of the
Go back to hiking, Kevin.
He's totally right. I've never gotten that call. You've never gotten that call. And also, if somebody did call me and said, hey, what do you think your house would rent for if it was fully furnished? I wouldn't have the first clue, and I'm in the business. So what is the value of that question?
Okay, that survey hasn't changed in forever, right? So even we can argue it's a terrible survey question. It is. Nobody even pays that rent. It's a meaningless number. No one pays themselves rent.
Yet
So
they are moving the markets with this information. Okay.
But it's the same survey question. So the question is, have owners become more optimistic about what they can rent their house for because home prices keep going up? That may be what's driving this process. I'm not an expert in that survey question. Don't get me wrong. But it's a terrible, terrible, terrible question. Owner equivalent rent shouldn't be asked. It's a stupid question. They should get rid of it.
So I was talking to my client last night, and he was telling me that the house that they're going to put an offer on, it was a year ago listed for $6 million. Today, he before this, he told me he was going to put an offer in for $2.5 million. And it's like this total beat up fixer upper, right?
That's $6 million. Okay.
Okay, but hang on. So then he goes, but the list price is 3.8. I'm like, but then he tells me about the $6 million, right? I went backwards. So anyway, bottom line is he's going to put an offer on this place, but it's been listed for 90 days. I look at the listing. I'm like, dude, not 3.8, 3 almost 4. I mean, 3 almost 4 million. So the point is, if you had asked that seller a year ago what her house was worth, she would have said $6 million. And even today, she thinks it's worth almost $4 million. Yet in 90 days, in a really, really hot market, the best time of the year, and everything's flying off the freaking shelves, that thing is sitting there for 90 days. So is her place right? So what value does calling someone and saying, what do you think this is worth have? Zero.
I can't argue with you. My contention is even more basic, is that no homeowner pays that amount. I mean, this monthly rent thing is not true. The only people who pay rent are people who rent apartments or rent single family detached homes. Those are the only rents that should go into the CPI number. But this OER number from this survey that you mentioned is included, and it's huge because so much of America are homeowners.
Yes, it's huge. Anyway,
so
okay. So
if we did the inflation measures the way the Europeans do, and I'm not always happy with the way Europeans do things, right? But our inflation numbers would be about 2%.
I'm interested in this. I don't know anything about how the Europeans do inflation numbers differently. Can you tell us in like?
They don't, they essentially, they have their way they do rents are much better than the way we do rents. That's the major difference, because CPI is 35 to 40% rent. CPI and core CPI is 40%. Theirs are much lower because they look at changing rents, not this.
Gotcha. Okay.
Yeah,
so
and rents naturally go up and down during the year. Just from a landlord's point of view, I see it all the
100%.
time. I'm always happier when my tenants give me notice in May, because I know I'm going to get a summer rent increase, versus if they give me notice in December, I'm screwed.
Right.
Screwed is
I
a
should either
technical
just
mortgage term,
leave it vacant for 6 months and then rent it out, or what do you do? But at the same time, as a landlord, you know that, okay, I know in the summer it can go for X, but in the winter it's going to go for Y, or X minus Y. What price do you? And I typically try to do something around the fall pricing, no matter what part of the year it is, because if I go for a summer, I've been burned on that, because they're more likely to bail on you because they see, oh, look, rates are a lot cheaper in the winter. We're just going to move in the winter. versus, and if you rent it out in the winter, in the fall or whatever, you typically get a stable tenant for a few years, which is what all landlords want. They want someone who's going to be there and be there for long term, because there's nothing worse from a landlord's point of view than a vacant property.
Right.
You just can't recoup that lost month of rent.
Right. And these rents, they vary, as you say. If you're a tenant and you're moving into the apartment, it's vacant, you as a landlord are much more willing to give me a month free or whatever it is to get me in.
Mm-hmm.
If I'm already there, you have me over a barrel largely, because I've already said to you, essentially, I'm too lazy to move. And therefore you can bump me up an extra % or 2 or 3 or whatever it is.
Yep. Absolutely.
All right. Elliot,
Hey, I have a quick question I did have for Elliot. There's something that Elliot always chats about, and I may have missed it in my, working around
your delinquency. Yeah, go ahead.
Yeah. All right. So, Elliot, you always go into the GDP and you break it down by, government spending, corporate spending, and personal spending. If you haven't done that already today, could you give us a quick touch as to where you see which one's going up, which one's going down? Are we seeing more government spending, less government spending, more corporate spending, less corporate spending?
So 4 parts of GDP. The first one's household consumption, C. It's 69, 70% of GDP, and it continues to be stellar. It's 2 parts. There's retail sales, and then there's non-retail sales, essentially, which is all services. And retail sales come out early in the month. They already came out. They were pretty crummy, and they've been weak for a while. But total spending, which includes services, has been stellar and strong. So ignore the retail sales. We've already bought enough television sets. Retail sales peaked out in, I think, early 22 or late 22 or early 23. And they've been declining now for a year and a half or 2.5 years, whatever it is, because we bought a lot of stuff during COVID. The fact that retail sales are weak isn't very shocking. The key thing is what's overall spending doing, and that we're going to find out on Friday when we have the income and outlays number, give us total spending. And that will probably be another good month, because labor markets are strong, employment growth is pretty good, wage growth is starting to slacken off. So I suspect that we may have a lull for the next 3 or 4 or 5 or 6 months. Wouldn't surprise me at all in that area. But so far, it's been strong. It's been resilient. It's the first star of the game. No question. Consumer spending sees great. Second term, corporate investment's been pretty good. It's not simply because firms are eager to invest. It's because Congress is telling us to invest. Congress is saying, build a chip plant because you'll get chip money. Build an electric car plant because you'll get IRA money. Or build a battery plant you'll get IRA money for. So we're building all these green car facilities and stuff. And then there's the IIJA, the bipartisan infrastructure bill, which is more roads and sewers and stuff. That's public spending, obviously, but that's been pretty good too. So oddly enough, if you look at all that construction spending going on and the fact that car sales are pretty good, because car sales were crummy during COVID because you couldn't get car sales, and home construction's pretty good because no one's selling their house because everybody has a mortgage from Audery that's 2%. New homes are good. So new homes, new cars, and construction aren't bad. That's why our economy is not in the tank right now, and is why it's able to withstand strong GDP. So corporate investment in plant, not bad, not great, but okay. Inventory, pretty crummy, and equipment, pretty crummy as well. So it's okay. The third term is government spending. We're picking that up in the construction at this point because of the green battery plants and the chip bill and the IRA bill and so on. That's where we're picking up the government spending, and it's been helpful, no question. But beyond that, not much is going on. The budget deficit's not going to grow this year meaningfully from last year, when it already grew a lot. And that's another reason we missed a recession. The calls that people like me were saying we're probably going to have a recession didn't materialize, in part because the budget deficit skyrocketed by 2 percentage points last year, which probably added at least 1 full point to GDP growth last year, which was 3.2. It would have been 2.2 or 2 without it. So we would have been much more likely to have possibly fallen, and we didn't. But we spent our money from COVID, and so these factors together and the big deficit help. So G is not going to help us. And last term, exports minus imports, it's small, negative 2 or 3% of GDP. We run a chronic trade deficit. It's going to get worse. It's worse because our GDP is pretty good. Interest rates here in the US are, 4.5%, 5%, depending on the treasury length and so on. But in Japan, they're 1, in Europe, they're 2 or 3. So people are selling their currencies, buying dollars, which pushes the dollar up, which makes imports into America cheaper. So someone like you, Kevin, who's now climbing mountains, historically, you might buy crappy, in quotation marks, American-made crampons. But now you're going to buy German crampons, and you can climb the Matterhorn with the best of them in Switzerland or wherever it is. So you're going to be buying more imports. Audrey, you like cheese. You're not going to be buying any crappy Wisconsin cheese. You're going to be buying French cheese or Dutch cheese or whatever it is now, or herring or something. So we're going to be buying more imports and bringing them into airports across America, like Phoenix and Los Angeles and wherever it is. So exports. So it's all going to rely on C. 70% of GDP, it's good. We need the labor market to stay good to see C stay strong.
Did that answer your question,
But
Kevin?
if the labor market stays, that answers that part. But if the labor market stays strong, that's going to keep inflation up. Am I correct?
And that will probably reduce the likelihood of it cuts. Yeah, for sure. Right.
Yeah.
That's why getting this avoiding a recession and getting interest rates, inflation down is a bit of a delicate balancing act that involves some luck. There is luck out there. Look, manufacturing's in a recession. Factory utilization rates are declining. More people looking for work. This is all pushing downward pressure on wages and stuff. Labor productivity is good. So there's a lot of good news out there on the slowing inflationary front. But you need some slowing in labor markets, and that could have deleterious effects. Yeah, right.
Well, and it's funny. We have a friend who at one point cautioned us on getting too excited about unemployment numbers going through the roof, because those are people and their lives. And, is it really worth it? And the answer, of course, is no. We want lower rates without, devastating people's lives. So,
and that's why we have unemployment insurance, because people lose their jobs. It's bad luck. These people don't deserve to lose them. It's just their company that they work for closed down.
Yeah, because everyone can
job.
survive on unemployment. Yeah, sure, that translates, right? So, okay. So existing home sales were down slightly month over month to 4.14 million.
New starts were also down.
Pardon me?
New starts were also weak.
Yes, a little bit. Yeah, so it's
not a great sign. This is the heat of the housing market, and you're seeing the impact of high rates, roughly 7%, whatever it is, but this isn't great news.
Okay, but what's interesting though, okay, so existing home sales for April, they were down 1.9% month over month, 1.9% year over year.
Year over year also, yeah.
But there was a revision. So anyway, so that's something. But the inventory level.
You guys revise numbers too. It isn't just the government.
I'm sorry, we had nothing
to do with these
revisions. Who in the hell comes out with his existing home sales? Who's responsible for that?
Okay.
Exactly. What was interesting though is the median home price actually edged up a little bit, and that was due to, in part, California is back. So homes over $1 million,
which is almost every home in California.
Yes, I don't know if that's true actually, but
it is 900,000. So
at least in the cities.
It depends. Yeah. I mean, there are certain, listen, I have a borrower who just bought a single family plus an ADU for $152,000 a few weeks ago. Now, it's in a place that you nor I would want to live in, but it exists. Okay. Okay. With that being said, and by the way, hardest loan I've done in, I don't even know how long. It was a torturous train wreck and I hated every second of it. And I got it done finally. Just for the 25-year relationship, but oy vey, that was a rough one. Anyway, bottom line,
you may have changed someone's life by helping them to squeeze into that home that for them was barely affordable.
What? They bought it as an investment property, and they're a really good landlord, so they are going to go change some lives. Actually, they're going to make they are gaining a reputation in that area for having really great rentals, and people want to rent from them because they're well maintained and they're good. They're decent. So actually, that is true. And thank God it's over. Okay, so $1 million plus increased inventory 34%, increased sales 40%. So anyway, so you're welcome, people. We are 25% of the US market, and a lot of people who don't live here are licensed here, and so it's good news for everyone, right?
Yeah, in terms of dollar volume, you're absolutely huge because you're a big state with very high home prices. I live in Florida. We're a big state, but barely half as big as you, and our prices are much lower, so we're much less important in the grand scheme.
Do you know that
the funny thing about
I saw a list of the least affordable states in the country and Florida was number one?
Yeah, that's because home prices aren't all that high, certainly compared to California or Washington, Oregon, whatever. Incomes here are low because we all work for Disney. And we all, can I grab your luggage? That's the employers. That's the questions employees ask here.
Gotcha.
Those are low paying jobs. Unlike California, where burger flippers just got paid now are $110 an hour, 120. I'm sorry.
It's
or
only
20.
21. Come on.
Yeah.
Sorry.
Actually, you know what? It's been like that at In-N-Out around here for years. You could get, there's a sign, $21.50 an hour. That was I don't even know what it says now, but anyway.
And that's entry level.
That is. Okay. So
their
I thought
managers make like 250,000 a year.
Well, they do anyway. Okay.
I'm in
So
the wrong career, changing businesses.
Yeah.
I thought this was interesting. Inventory, 1.21 million units, 3.5 months supply, 26 days on the market from 33. That's an improvement. That means even though the prices are going up, that people still want them. Sold over list price, that's 27% of the market. First time home buyers, 33%. Cash buyers, 28%. That's the same. Investors, 16%. So, they're first time home buyers, 33% of the market. That is literally a third. So all of the, it's all totally unaffordable is not quite the case.
No,
And people
I'm getting the calls from first time home buyers and they can afford.
Yep.
Even at the higher rates.
Okay. So Elliot, I want to take a little tiptoe into November, and you know that we are very agnostic here.
Edvard Munch painting,
Maybe
the screen.
Yeah. I mean, we do not take sides politically.
Right.
So this is not about that at all. So what are your thoughts on whatever happens in November? What does that mean for mortgages? Do you have a take on that you can share with us carefully?
So it's hard to know. I mean, so much of what a president deals with at the end, there's complete unknowns. There's wars, there's famines, there's this, there's that. They don't control the agenda. They think they do, but they don't. And you see that all the time. So all you can do is look at what they say. And that's limited because even what they say, they may not do it because the composition of Congress may well prevent them from doing it. If the Democrats pick up, I'm making this up, Trump wins because it looks like if the election were held tomorrow, it looks like he will win because he's ahead in those 5 of those critical 7 swing states. So things can change, but whatever. But who knows about Congress and the Senate and the House? So it's hard to tell. We know that if President Biden wins again, he'll do more of what he's done, more social spending, more green energy, probably try and raise tax on people earning more than $400,000. Okay, we got that. We may not be thrilled with it, but we understand it. Okay, fine. If President Trump, it's President Trump and President Biden, first time since way back when, Cleveland and Harrison, and Cleveland again, McKinley, Roosevelt, Taft, Wilson, Harding, and Coolidge. Okay, I memorized my presidents. But if Trump wins, there'll be less regulation. We know that. That's obvious. We had a regulatory relief and holiday between 17 and 21, 17 through 20, when the Trump administration was there. But his rhetoric makes me nervous. And it's a couple things in particular. One is this imposition of tariffs across the board on all imported goods of 10% roughly, and much higher duties on Chinese imported products. Now, it's true that President Biden has just imposed a whole bunch of tariffs on Chinese products, but those products aren't products we actually buy a lot of. I mean, Chinese cars in America, they're few and far between.
I didn't even know they made cars.
Outside of Polestar, I don't think there are any really Chinese-made cars. I mean, Volvo, I'm not sure if they make them in China or in Sweden and they import the Swedish cars to America. We can argue. But there's not a lot. Steel, yeah, it's $1 billion, not a lot of money. But if we impose heavy tariffs on everybody, we'll get everybody angry, they'll retaliate. This is a road to inflation, a weak economy and inflation. This is really bad. And then the other thing he talks about, 2 other things. One of them is getting illegal immigrants into the country. And we can argue whether we want legal and illegal immigration. Yeah, that's a bad topic. I get it. But we are in no position because of natural births over deaths and population growth, domestic population growth, to be picky and say, well, we really don't want these folks. They're employed. We need them to do the jobs that they're doing. Whether they become citizens and how and if and what, different question. And the last thing that makes me nervous that he talks about is the central bank. And he's trying to figure out a way to get the central bank to answer to him or the Treasury Secretary or to chip away at their independence. This makes me very nervous. This is a guaranteed recipe for inflation. So all the things that he wants to do, immigration, tariffs, central bank control, they're all inflationary. So this makes me say, I'm kidding when I say this. If he wins, buy Bitcoin, buy gold. I'm not literally saying that, but his rhetoric is inflationary. Again, it may not come to pass and so on. And Biden, things happen. They may not live through their term. Their vice president could take over. A lot of things could happen. But I'm a little more nervous on the Trump side because of what he's saying. Now, he's saying more because he has to generate enthusiasm among his base, too. So we don't know what Biden would do if he were the other side of the coin and the non-incumbent. But that's where I sit.
I think it's interesting with the tariff thing, which I just recently became more aware of, where Trump imposed the tariffs, Biden campaigned saying how terrible they were. He gets into the office, he leaves them in place, and now he's imposed his own. So I don't know enough about any of that, and I don't know how much it impacts us, but I mean, in mortgage land, but it's interesting how, and both sides, in my opinion, do this. So, oh, that's so bad. Okay, I'm going to keep doing it, and now I'm going to do it some more. And then you're going to come and go, well, I'll show you. I'll do it some more. So it's yikes.
Now the thing that's even more important and overarching is you cannot solve the trade deficit by imposing tariffs. The trade deficit, the size of the trade deficit, is independent of trade. This is crazy, but listen here. The reason China runs a trade surplus is because they save a lot of money. The reason we run a trade deficit is we don't save enough money. It's savings and investment decisions made by households and firms that lead directly to the size of the trade deficit or surplus. So when you impose tariffs, you're making households and firms poorer. That reduces spending, which reduces the trade deficit. It has nothing to do with the duties in and of themselves. So if you want to, we have to get Audrey to save more and invest less or consume less or buy fewer vacuum cleaners or whatever it is to reduce the trade deficit. So this is attacking a symptom, not the problem, if you will. Tax policy would be a better methodology to solve that problem by encouraging savings or discouraging investment or whatever it is. But it's savings and investment that drive the trade deficit.
Oh my goodness.
Okay. Which is crazy. But
so, I mean, it'll be really interesting. It's all going to play itself out no matter what we think or want or do or whatever.
And it'll all be different. It'll be completely different than what we think.
Right. But that's very possible. And so I will just say yet again, just put your nose down and do some loans.
Do loans and ignore it. Ignore it in your personal life in terms of investment decisions. I mean, I'm not a financial advisor. Don't sue me. Talk to your lawyer, talk to your accountant, and so on. But the data shows you can't beat the market. Republicans, Democrats, the stock market. Yeah. It did well under Obama. It did well under Trump. Done pretty well under Biden. Let it go.
Yeah. And we go in cycles more than anything else, don't we? Like, aside from a pandemic or a war or something like that, I mean, it's
you look at recessions. Recession of 1970, 1980, 1990, 2001. That's pretty much a recession every 10 years. I hate to say it, but yeah, wow. There are recurring themes here.
Yeah, there definitely are. So,
and accidentally, oddly enough, recessions, they all come during Republican administrations since Nixon. It's just the way it works out. It's not their policies like COVID, it just happens. So the population is tiny, few presidents, like 10 since Nixon or 9 or whatever it is. But don't think that, Republicans in, it's going to be good for the whatever. Maybe.
Yeah.
Rates
and also we can't discount the impact that Congress has. So
absolutely. Big time. Big time.
Yeah. So all right, kids, we'll buckle up because that'll be interesting. I just want to take a second because you live in Miami and you own a condo, and we had a whole thing on condos a few weeks ago that was really, really interesting. And we learned so much about what's happening in the associations. And, Florida was definitely part of my research and what's going on there. Tell me a little bit about what you're seeing that you were.
So we're seeing a couple of different things. First, inventory is going up. Not in Miami as much, but in Tampa, for example, inventory is up year over year, 50, 80, 100, 120%. Now, there's still
in the condo market, just condos?
No, overall.
Oh, wow.
But there's still 3.5 months of inventory. So there's still a little inventory starved, oddly enough. But inventory is coming up here in Florida. There's no question. And the condo market, what you're beginning to see is differentiation. We're not just saying, I want to buy a condo. It's I want to buy a condo in a building, or I know I'm not likely to experience a large special assessment to fix the rebar in the balconies or whatever it is. And some of these special assessments, and the journal papers, newspaper, New York Times, whatever, talk about them, 100,000, 200,000. Now, if your condo's 5 million, yeah, okay. But if it's $1 million condo and you're paying $100,000, $200,000, that's an immensely large amount of money people can't afford. And if it's a $500,000 condo, which has happened, I mean, your condos would become essentially unsellable.
Yeah.
So people are now becoming much more discerning and saying, well, what's your history of specials? How fast are you going to build up your reserve, which you have to do by Florida law? How are you going to do it? What will my monthly payments be after that, or whatever? So we're beginning to see some differentiation between age of building and better conditioned buildings and so on. It isn't a blanket disaster area, although none of it's helpful in the short run, because building up reserves is expensive. You either have to do it through monthly payments, special assessments, or borrowing from a bank where you're paying interest. I think my building is doing a little bit of all of them.
Interesting. Yeah, it is really something to keep an eye on. And, some of us have been telling people for literally our whole careers, go read the last 12 months of the board meeting minutes to see what is in the works. What are the reserves? And now, even though there has been no oversight over condos whatsoever, other than, the financing regulations, those are driving this yet again, because again, there's no real overarching regulatory agency that looks at HOAs and how they're managed and are they funded correctly, et cetera, et cetera. So it is, I would just encourage people to, go to our YouTube channel, watch that show, whenever that was.
Look at those reserves and how fast they're depleting, and how fast they're repairing elevators and roofs and all these sorts of things.
But also there is a company out of, not out of Florida, that is doing reviews, like preliminary upfront reviews for listing agents and their sellers to see, okay, from a financial money perspective, will you qualify for a loan? Probably. There's no guarantee, because as we learned, you can go from being approvable to not approvable overnight, but at least gives your buyers a much better idea of what they're wading into. So anyway, it's something to really, really watch and to be aware of. And with that, I just wanted to also add one little thing, which I thought was so interesting. So it's very expensive to get VOEs these days, very expensive, like $100 a pop sometimes, or 90 or something ridiculous like that, a verification of employment. And I saw a note in Rob Chrisman's blog this morning and actually talked to him about it. There are some lenders who are now, to save cost, going to manual verifications of employment again. So it'll be interesting to watch that, because again, sometimes it's very hard to use the automated system to get things like, overtime or bonuses, that kind of income broken down. And so you almost need a manual VOE anyway. And I always tell my borrowers, I'm like, look, if you don't like that cost, your employer decided to use that service, so talk to them. So anyway, so just something to be aware of, as we are finding maybe the technology has outpaced its value to some degree. And maybe just be aware some places are going old school. So with that being said, again, go to YouTube and go to Mortgage Pros 411 and subscribe, send your friends, and we will look forward to seeing you next week. But Dr. Elliot Eisenberg, I cannot thank you enough for being here. It was a pleasure and always so informative. We will have him up on our YouTube channel as soon as our friend Jason Bellevue gets it up there. He does this out of the goodness of his heart. So we're so grateful, and he'll get it done as soon as possible. With that, have a wonderful week, guys. Thank you.
Thank you so much, Audrey. Thank you,
Thank
Kevin.
you, honey.
Yosemite.
Thank you, Jay. Thank you, guys.
Bye.